and welcome to the State of the Economy discussion. We've got two important numbers. The January CPI rate coming in at 5.1%. The CNBC-TV18 poll was 5.03. So this is as good as almost there. Well, you can crib, it's a little above expectation, but this is a damn good number considering that in December, the CPI number was 5.69. So it's quite a fall from those levels. And more importantly, the IIP number has also come in, the industrial output number for December. And that is a very positive surprise. It's come in at 3.8%. I'm calling that positive because the CNBC-TV18 poll was expecting it to come in only at 2%. So we have a fairly decent number coming in on the industrial output number, which also is pretty important. Let's get to the CPI number itself. The food price inflation has come in at 8.3%, and that's not a good number because our poll put the CPI number to come in at 7.4%, and that would have compared with 9.5% in December. That it has not fallen all the way would be a bit of a negative for the markets and for the RBI in particular, because RBI's plaint has been that while core inflation is falling, food inflation remains intractable for various reasons, and that is preventing the RBI from achieving its 4% overall headline inflation, which even now stands above the 5% mark. Perhaps the Reserve Bank was definitely in on this, and that's why it did not give us even a little bit of a dovish stance when it spoke on February 8th. 5.1 is still a distance away. We are not even sub 5%, though the RBI is expecting Jan, Feb, March average to come in at 5% and not 5.2. So hopefully we are going to get one reading at least in the subsequent months, which will be below 5%. To come in with more details, the food price inflation has come down 0.7% on the month. That's not a surprise. Winter months do show lower inflation month on month, but the overall number is not adding up in year-on-year terms. The vegetable index is down 4%, 4.2% month on month, while cereals and allied products are up 0.8% month on month. And that's going to be the Reserve Bank's worry. That cereals, which have a huge weight in the index, are the items that are not coming down much. It's a 12% weight in the index. And that's the number which is continuing to be, high. Cereals year on year is up 7.83%, and that is a bit of a heart attack for those who want that number to come down. The other difficult number is pulses, which is up 19.5% year on year. Pulses, my guess is also up month on month. I'll just give that number to you in a minute. Pulses is, okay, it's not up month on month. It's actually down month on month. So that'll be a bit of a relief. But pulses still year on year, a big number, and cereals up month on month and up 7.8% year on year. The vegetable index, like I told you, is down 4% on the month, but year on year it is still a tall 27% higher. So the difficult elements for the Reserve Bank and for the food price index: cereals up 7.83%. We have vegetables up 27% and pulses up 19.5%. Spices have been high. They were in the 20s. Now it is up 16%, but it's not a very weighty item. So we can let that go. What's helping the food index? Meat and fish up just 1.2% year on year. Eggs also a bit of a worry, up 5.6%. That's the next big protein item after pulses. If pulses is up 19% and eggs are up 5.6%, we have a protein price issue over here. Milk is, of course, beginning to come down for the past 3 or 4 months, and it's up only 4.6%, which is welcome. Oils and fats has been our strength. It's down 14%. Remember, a year ago we had the fallout of the Ukraine war and edible oils being higher. So we are still harvesting those gains. Edible oils down 14%, 15% almost year on year. Fruits is up 8.6%, not very good. Vegetables, I told you, up 27%. Pulses up 19.5%. Sugar up 7.5%. and spices up 16%. So all told, foods is still a very difficult basket. Housing and the housing index, just give me a minute. Housing index is up 3.2%. So that is a very big relief. And fuel is minus 0.6%. So all those are the ones that are a relief for the Reserve Bank. Services is up only 3.8%. It comes under the head of miscellaneous. And over there, all the numbers are very benign. Household goods and services up only 3% year on year. Health up 4.8%. Transport and communications 1.96%. Recreation and amusement 2.89%. Education 5.93%. And personal care and effects 5.94%. So services is not a very big deal. It is food that is misbehaving seriously for the Reserve Bank. Very quickly, I'll read you through the industrial output numbers. The overall number has come in at 3.8%, and there is a decent 10.4% growth in electricity. That's the best number we have. That's for December. The other number that's done well is, 1 minute, manufacturing would be, manufacturing is also done well actually, 10.4. 1 minute. Okay, manufacturing is 10.4, electricity is 5.1, and mining has done 5.1. Well, there's some mistake over here. I'll get back to you with the December numbers, but the overall December number at 3.8 is a bit of a relief. I'll come with the details in just a minute. Electricity is up, 1.2 versus 10.4 year ago. I was reading the wrong column. And manufacturing sector is up 3.9%, better than the 3.6 year ago, and mining is up 5.1. So it is electricity that's been a little of an underperformer compared to the year ago levels, which was very good. Otherwise, capital goods growing at 3.2 is again subdued, compares with a 7.8, a decent base year ago. Infrastructure up 4.1. Consumer durables has done very well, up 4.8, but then that's a very pathetic base. Consumer non-durables is up 2.1. That's broadly the industrial output number. Okay, but it's the 5.1 that we have to look at, and I was looking for yes, here is the core inflation at 3.6%. That was the CNBC-TV18 poll. So core inflation, if that number can come up for us at 3.6%, is a very big relief for the Reserve Bank, way below the 4% mark. And if sometime in the future we have to expect dovishness, change in stance or cut from the Reserve Bank, it is core inflation that will help us bring the headline down. With that rather elaborate preliminaries, let me invite my panel. I'm joined by Rupa, Rege, Nitsure, the Chief Economist at L&T Finance, Nikhil, Gupta, Chief Economist, Motilal, Oswal Financial Services, R. Sivakumar, Head of Fixed Income at Axis AMC, and Sakshi Gupta, Deputy Vice President, Senior Economist at HDFC Bank. Ladies and gentlemen, okay, it's an even house. Thank you very much for joining. Rupa, 5.1, you think we will be able to manage under 5%? And what is your comment on the internals? I think you're on mute, Rupa.
I'm really sorry for that.
Go ahead, please.
It is perfectly in line with my forecast. My forecast was 5.09.
Okay.
And I was tracking very closely, sequential movement in the prices of pulses and cereals and vegetables, etc. So sequentially, prices have declined, and that's definitely a positive thing. Year on year, of course, last year, the base effect for food prices was very high. So, over that, the deceleration was expected in inflation. So, month on month, it has come down by 68 bips, which is a positive thing. But as you very rightly said, Reserve Bank had very clearly said that, both the food as well as fuel inflation have potential or tendencies to spill over to core inflation and get into generalized mode. And that's why they will stay cautious, because even at this stage, we are seeing a lot of inflationary buildup in the prices of cereals. Also for pulses and other stuff, government's supply side measures also have helped a lot. But we cannot expect them to be permanent. Those measures are always by nature, they are transitory in nature.
Okay.
So eventually, the demand supply forces only will decide. But yes, fourth quarter is going to be quite positive on inflation front because the statistical base of last year is also very high.
Okay.
So we are going to see better prints going ahead, and core inflation at 3.6% level definitely is a welcome
Very
phenomenon.
fair enough.
And a lot of credit for that goes to RBI's sustained tightening stance.
Okay.
And I'm happy that they didn't loosen it this time also, because our past experience shows that any premature easing always re-accelerates inflation.
Yeah,
So
fair
I think
point.
they have been cautious, and I support that.
Fair
Thank
point. Nikhil, your thoughts? Yes, the base will be working in favor of a lower inflation number for Feb. Jan itself, the previous number is 6.5. So over a 6.52, we have got a 5.1. Do you think we are on course for a sub 5 number?
Hi, Latha. Yes, so Latha, we do see inflation easing to 4%, which is what the RBI also forecast by Q2 of FY25. But that is only for one quarter. From the third quarter, we believe that inflation could go up to 4.7, 4.8% in the entire second half of FY25, which is also, again, in line with the RBI forecasts. So to answer your question, yes, we do see not only below 5%, but we do see it touching around 4% in the middle of next financial year. But that would be only temporary, neither in the first quarter nor in the third and fourth quarter of next year we will be seeing anywhere close to 4 or 4.5%. We see above 4.5% for the full year and in 3 quarters of next year. So I will not take too much comfort with the 4% that we expect for the second quarter, only one quarter.
No, I'm just actually asking you, I'm splitting hairs over here. Just looking for the current quarter, the Reserve Bank had brought it down from 5.2 to 5. Now, this number has come at 5.1. By March, we lose the base effect. March of last year was 5.6%. So this is a very minor thing for the Reserve Bank, whether the Jan, Feb, March is 5% or 5.1, but will they get to 5?
No, we are tracking slightly closer to 5.2 actually, not at 5.
Okay. So,
and for the first quarter also, RBI is at 5, we are at closer to 5.5. But the next 3 quarters, we are in line with the RBI's forecast.
Okay, so this 5.1 just looks like it may be difficult to bring it to 5 in this quarter itself. Sakshi, any thoughts on the internals of this number, especially food? It's looking intractable. Our poll was 7.4 and this one has come in at 8.3. Cereals and pulses. Cereals actually higher month on month. Would that kind of spoil the picture for any policy loosening?
Yeah, no, I agree, Latha. I mean, while the headline inflation number at 5.1 seems like a positive good number when you compare it to the previous month. And even on the core side, I think there's good news and it's coming at 3.6. That was our forecast. But I think I'm concerned about I'm not as confident about the food inflation bit because while on the pulses side, you have started seeing a sequential slowdown, over the past couple of months. But cereals inflation and the print we've got today, it seems a bit worrying also because, it tends to have second round effects. So, your other items like you mentioned, egg, milk, all these items can, start going up again.
Yes.
And I think something that we have to, just put in context to the inflation discussion, we are looking at a range of 4.5 to 5.5 for the next 5 or 6 months on inflation, right? But the challenge really is that with core inflation seems to be now stabilizing between this 3.5, 4, you're really vulnerable to what happens to food prices. If you have to, to quote the governor, he mentioned that the last mile of disinflation could be very challenging. So in that context, I think the food inflation momentum month on month that we have seen this for January is a little on the higher side, and I'll be a little cautious on that.
Okay. Well, Sivakumar, would you say that all this is of academic interest only, and the big inflation number is going to be what will be announced from the United States today, the CPI, tomorrow, the CPI number? The US yield is running at 4.17%. So would you say our inflation number can't really move the needle much? How would the bond markets take this number?
So this bond markets, I think we're expecting just a touch under 5, I think. So the fact that it printed just above 5, I think will be a bit of a disappointment, but it's not a big deal, I think, because all of it is coming from food, which was always the uncertain item. So I don't think this is going to be a huge shocker. I think some of the questions that you asked earlier, I think, are very important. I think the most important thing is the trajectory over the next several months. And I also agree with the other panelists that the important thing is to look at how inflation pans out over the next few quarters. I think whether it's a US or the India, 1 month sprint is not the real story. I think the crucial thing here is 2 parts. One, 3.6 on core. And remember that core is where monetary policy has the greatest effect, right? But given that almost half the inflation basket for us is food, the RBI cannot ignore it. So they need to look at the composite. And if they want to drag composite down to 4 and the food continues to surprise above 4, then they have to maintain tight monetary policy so as to drag 4 lower. And of course, they're worried that the spillover goes the other way and food inflation spills over into 4. So I think the worries for RBI are clear, and today's print is not going to help them. They are going to be quite cautious. US, I think, again, I agree with you. I think the reality is that RBI is going to be quite dependent on the US, not in terms of the rate cut trajectory, but just in terms of the timing. I think if the US starts its rate cut as we expect, perhaps in the second quarter of the calendar year, then the second half of the year is opened up for RBI. But I think if inflation numbers surprise on the high upside, then certainly we are looking at a slightly delayed trajectory. So I think the importance of the US inflation print on our markets is limited just to the timing impact rather than anything else. I think the RBI will look at this number. They will look through this number. They have mentioned that they look through this food inflation print unless it spills over to core.
But will it make a big difference to a bond buyer like you if the US yield is going to remain at 4.17? The US yield is not just dependent on the core inflation reading that we are going to get. It's also dependent on the issuance. And US deficit is not reducing in an election year, at least the first quarter deficit from October, November, December of 23 indicated that. So do you think that bond markets are not going to get much joy only from the rate cuts? Are we stuck at a high level because of these US yields?
I don't know whether there's a direct relationship. Remember that when we talk about the demand supply factors, right? And for India, we are looking at a very positive demand supply, given this JP Morgan and EM indices, etc. We are looking at a very positive demand supply scenario over the next, let's say, 12 months. But for the US, it's the other way around. As you mentioned, high deficits ongoing as well as high refinancing costs. I mean, they are having a lot of maturities coming up. A lot of short duration borrowing, which was done during COVID years, are up for refunding. And therefore, the issuance has really gone up. And right now, with the Fed still maintaining a tighter stance and not monetizing or not in a QE mode, certainly they are facing the other problem. So every quarter, when you get a funding statement, it looks very, very difficult for the market. So I'm not looking at these two and saying that there should be a correlation.
So they have a supply problem. We don't have a supply problem. We have actually a surfeit of demand that will hit us starting June 28, if I'm not mistaken. So that problem may not hit us. At the moment, actually, bond yields have gone up to 7.1 from 7.04 or 05 it touched on Monetary Policy Day. Let me now quickly come to the industrial output number. It's not a number which I know you people take very seriously because there are so much other growth indicators. But two things have happened. The December number has come in at 3.8 versus our poll of 2%. And the government has corrected the April-December, rather the NSO, has corrected the April-December industrial growth to 6.1% and not 5.8. So I think there is No, 1 minute. I think this is an Informist revision, not the Government of India revision. The April-December number is 5.8. Nikhil, what do you make of this? Do you think that this number is telling us that growth is better than estimated? 5.8 for April-December and December itself 3.8, better than expected.
So Latha, we were expecting IIP growth of 5%.
Oh.
Which was much higher than the market consensus for December.
Okay.
Okay, so it is 3.8%. Again, it's only 1 month number. If you look at the quarter, for the third quarter, that is December ending quarter, we believe that we will be somewhere around 6.4, 6.5% real GDP growth, which is what the consensus and where the RBI also is.
Okay.
For the next year, we believe the market and the RBI in particular, or the government, are very optimistic when they talk about 7% real GDP growth.
Okay.
I still believe that it would be more like below 6%, very unlikely to get 7%.
Oh, okay. Oh, yeah, that's a discussion for another day. I think we would be meeting on Feb 29 when we will be discussing GDP numbers. So perhaps that discussion at that time. Just finally, Rupa, what's your sense in terms of the Reserve Bank's dilemma? Food is not something that they can manage with interest rates, and yet food is looking pretty disobedient. And this is very much an India phenomenon. At this present point in time, the FAO index, the Global Food Index, has fallen considerably compared to 2022 when the Ukraine war broke out. Food inflation is like sizably down. If I remember right, it's fallen from about 150 index to 124. I may be wrong by a few points, but it is distinctly lower. This is a domestic problem. So does it take away Reserve Bank's freedom to do much in terms of changing stance or policy if food continues to be at these, 8% levels?
Yeah, because you see, even IMF in its Article 4 consultative discussions has very clearly brought out this fact that India's inflation experience is very different from the experience of developed countries. And, during the COVID time, when they were facing very high inflation, our inflation was not that high. And now when their inflation has come down drastically, we are facing problems because of food inflation, because a lot depends here on our, local monsoon situation, water reservoir levels, and, every country suffers from differential impact of climate-related risks, etc. Today also there is a warning of hailstorms, so there are concerns about the Rabi crop. And we all know that going by both the Kharif and Rabi seasons, maximum damage has been made to cereals and products. Naturally, we are seeing price pressures getting built up in that category, and that is very important. Yeah. And ahead of elections, there could be higher currency in circulation that will also fuel inflation. So there are many upside risks to inflation at this stage for Reserve Bank of India. And but I feel that they have been, their guidance is very, very transparent. Their communication is very straightforward. And Governor practically in every policy statement has been saying it very clearly that they want to bring down headline inflation durably to 4% level. So as long as, it hovers around 4%, I'm not seeing personally any change in the stance, because change in the stance tantamounts to lowering of interest rates, because when you increase liquidity, naturally interest rates will come down. So I think this whole higher for longer narrative appears to be more relevant for India at this point of time, rather than expecting any premature easing. Of course, the base case is that many people, market participants, are expecting, policy stance to change in August, and after that, some shallow easing will and all. But I think they will remain in data-dependent mode and avoid any kind of premature easing, because we have reached this level with lot.
Yep. Oh, we just lost Rupa. But anyway, I think the point is made that food inflation is going to be an issue Of course, for the market, the call rate is another issue. Another variable rate repo has been announced. The last week announcement was expected to be over 2 lakh crore. It came in at 1.75. There is another 25,000 crore announced today in terms of repo, which the government is giving. I mean, RBI is giving to the market, but the call rate has even touched 6.8, 6.85 today. So near-term money is still tight, which means deposit rates will be high. But to cut a long story short, the key takeaway from today's numbers, the inflation number is a tad higher than expected. But we are really squabbling with, a 10, 15 basis points here and there. The market was prepared for sub 5%. Our poll was 5.03. The actual number has come in at 5.1. So marginally higher than the market expectations. But the deciding factor for yields will also be the US CPI. At the moment, all we can say is this is not very great news. It's just about median to slightly bad news for the market. The industrial output number looks slightly better than our poll, but that at 3.8 is not something to sing about. It's just a little better than expected. So today's numbers, nothing very heartening for the market. Cereals inflation, food inflation is the big negative from this set of numbers. It will mean that inflation will continue to plague. It will mean that Reserve Bank will not be able to bring down its stance or sound dovish anytime soon. But more than anything, it is very negative news for consumers. It is negative news for FMCG companies, for whom food is both an input and a reason why people will not be able to buy other consumer non-durables, because a large part of their money is taken away by the consumption of food. And this is a very basic item, cereals, that's gone up 0.7% month on month. So that's the only bad news from this entire complex. Otherwise, more or less on expected lines. That's it on this edition of State of the Economy. Thank you very much, Rupa, Sakshi, Nikhil and Sivakumar for joining us. And all of you, stay tuned in. After the break, lots of news and updates for you. Well, it's almost inline expectations. No, I'll do it again. 1 minute. Okay. Can I start? Well, today's inflation number is a slight disappointment for the market. While it's 5.1 compared to 5.03, which is CNBC-TV18 poll, many in the bond markets were expecting a sub-5 number, 4.95 or thereabouts. That's always psychologically more satisfying. Now, the Reserve Bank in its February 8th policy had brought down its forecast for Jan-Feb-March quarter from earlier 5.2 to 5%. With January itself coming at 5.1, chances are it may not be able to meet the 5% forecast. It could be ending a little higher, but just marginally higher, if that. The only worrying part of the inflation number is not this headline inflation of 5.1, but food inflation, which has come in at 8.3%. Now, the CNBC forecast was 7.4. Last month, December was 9.5. Compared to that, 8.3 looks good, but the internals of food is not very satisfying. Cereals inflation is up about 0.5% month on month. It is up about 7.9% year on year. Now, cereals is a good 12% of the CPI basket, and cereals, of course, is, the staple food for the country. That index, that price item going up month on month and year on year is going to be very negative from a political standpoint, from a humanitarian standpoint, and definitely from a policy-making standpoint for the Reserve Bank. The other numbers, vegetables, pulses are all coming down, but pulses is still about 19.5% higher year on year. That will also be a source of worry. Other elements in the food basket are not too bad. But winter is always the best time for veggies and fruits. So, we can't be too happy that veggies and fruits have come down month on month. By the time we come to March, April, even those could rise. Sugar is another negative element. It's up about 7% year on year. So the government and the Reserve Bank have their task cut out when it comes to food inflation. The positive for the Reserve Bank is the fall in core inflation to 3.6%. Now, core inflation is something the Reserve Bank's interest rate policy actually impacts. And that's a success story, coming down to 3.6. well below the 4% mark, which is the mandated headline inflation target for the Reserve Bank and the MPC. So that's the good news. Very quick mention, IIP number coming in at 3.8% is better than our poll of 2%. Within IIP, it's manufacturing at 3.9. Nothing very gung-ho. Capital goods has fallen a bit to low single digits, but consumer non-durables and durables are at least in positive terrain. But the IIP number is nothing much to write home about. It's not very important for policy making. It is CPI that's important. And over there, it is, well, not very good news. It's just about a little higher than expected. So bond markets will not be cheered much tomorrow by this number.